Today, the Dow Jones Industrial Average is down 1%, the S&P 500 down 0.7%, and the Nasdaq is down about 0.5%. And we did have a lot of Fed speakers today. We did have a lot of economic data that came out today. One of the key things is the PCE. The Fed's preferred gauge shows inflation accelerated even more than expected in August. This has a lot of economists talking about the doom and gloom that is ahead for the S&P 500, and we're going to talk about specifically in this video what we need to see for the pain to end in the stock market for some of our favorite stocks, which is included in that AMC and some of the largest runners, or some of the stocks that have the largest potential to be big runners. So we're going to dive into this whole entire situation. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to get free stock, also links down there as well. And if you guys want to come trade with me live in real time every time a trade is made, link down below in the description as well for that one. Now let's dive straight into it. So first things first, let's talk about what happened today, and we will make our way to the economic calendar. So for the day, for Friday, September 30th, the last trading day of September, which September tends to be a very bad month, which it looks like that is going to be the case for this September as well. Now, at 12:30 p.m. you had personal spending month over month for August, personal income month over month for August as well. That was not so good. PCE, which was also not so good. You also had Fed Barkin that spoke today, Fed Mester that spoke today, Fed Williams and Fed Brainerd that also spoke today, and you did have the Chicago PMI for September and Michigan consumer expectations. Now, the Michigan consumer expectations, that's important for inflation, because what people tend to expect inflation to be, if they think it's going to be high or low, that's usually what ends up happening. And the short-term inflation expectation actually did go up more than people expected, but the long-term inflation expectation did go down. And I think that's why you did see a pretty volatile move once that did come out at about 2 o'clock. But you didn't get a follow-through, because I think it's really a 50-50 kind of thing. Short-term, yeah, that's not good. Long-term, that's really good. You want to see the long-term expectations for inflation definitely going down. Now, you do have Fed Bowman that speaks at 3 p.m. as well today, and at 8:15 p.m. you have Fed Williams that speaks as well. But let me take you guys to this article which breaks it all down for us on essentially what these Fed speakers have been saying. So, stock market gloom, worse than ever as Fed signals it may keep tightening until recession. Fed officials on Thursday reiterated calls for aggressive policy to combat stubbornly high inflation, fueling expectations for bigger rate hikes amid a stock market sell-off that's seen major indexes hit new lows for the year, and some analysts project that the losses could only deepen. Real interest rates, which have remained negative since July 2020, quote, have to be in positive territory and held there for a long time, Cleveland Fed President Loretta Mester told CNBC Thursday morning, laminating that inflation remains too high and warning the Fed still has room to raise rates more. Quote, we're still not even in restrictive territory on the federal funds rate. In a speech on Thursday, St. Louis President James Bullard issued a similarly hawkish call, saying it does not look like the Fed is expecting a fair amount of additional moves this year to put meaningful downward pressure on inflation. Expectations for rate hikes climbed, and the comments, with markets on Thursday pricing in an end-of-the-year rate at 4.5%, above the 4.4% rate Fed officials projected earlier this month, which itself was 1 percentage point higher than the forecast in June. Quote, the gloom is back, and it's even worse than ever, analyst Adam Christofoli of Vital Knowledge Media said in a note as stocks plunged Thursday, adding that markets could bounce back again as they did earlier this week, but the S&P will struggle to climb back above 3,900, about $390 on the SPY, 7% higher than current levels, until Fed projections, which are contingent on inflation coming down improve. In a note, Morgan Stanley analyst Michael Wilson said the firm remains convinced that the S&P will hit an eventual low of between 3,000 and 3,400 points later this year or early next, suggesting it could still plunge another 7 to 18% from here. Analysts at Goldman Sachs and Bank of America are slightly less bearish, predicting that the S&P will only fall to about 3,600 in line with current levels, though Goldman also noted the index could tumble another to about 315 on the S&P 500 if the economy falls into a recession. And the critical quote for this article, quote, "The Fed is signaling they expect to tighten monetary policy enough to cause a recession," says Bill Adams, chief economist for Comerica Bank. He notes economic data released Thursday reinforced the likelihood of another 75 basis point rate hike at the Fed's November meeting. Data from the Bureau of Economic Analysts showed the economy grew 1.5% more since the start of the recession than previously known, and jobless claims unexpectedly fell last week. And that is a big thing that happened yesterday, and the main reason why the stock market was down over 3% on the Nasdaq was because the jobless claims did not fall enough. They were much better than what people expected, and if people are not losing jobs yet, if there's still so many job openings, 2 job openings for every 1 person looking for a job, then the Fed thinks they have more room to raise rates. Unlike the UK, which they had to come bail out their bond market, it does not look like the Fed, as of right now, is going to bail out the American bond market. We'll see what happens. Maybe crazy things have happened before, but it doesn't look likely as of right now. Also, this is what happened today, and I already read this, but I'll go ahead and reread it for good measure. The Fed's preferred gauge shows inflation accelerated even more than expected in August. The key points: core inflation rose 4.9% from a year ago in August and 0.6% on a monthly basis, according to a measure the Federal Reserve watches closely. Personal income rose 0.3%, the same as July, and in line with the estimate. Spending rose 0.4% after declining 0.2% the month before. Headline inflation, including food and energy, also accelerated despite a sharp drop in gasoline prices. So basically across the board, we got upset yet again today, and that is why the Dow is down 1%, the S&P down almost 1%, the Nasdaq down 0.5%. It's because the data we need to start coming down, to see inflation's coming down, to see the Fed might not have to raise as aggressively. The economy is starting to tumble. We're not getting that data as of right now, and that is fueling just some pretty choppy movements in the markets and a lot more expectations for rate hikes to come. Now, I will note that the S&P 500 is finding a lot of support and bobbing back and forth around the 360 level. So we have now seen a triple bottom around 360, and it looks like if we close under 360, that will be the first day that has actually happened of 2022. So it looks like we're in for the worst close of 2022 so far, and that could be a precursor of what is to come, or I think it's more than likely you can get some upside relief from here until we get the next data point, the next Fed meeting, the next time Fed Jerome Powell speaks, or additional large earnings such as Apple, Tesla, Google, Amazon, Microsoft, so on and so forth. Companies that control a vast majority of the stock market that give us just really bad numbers, right? Until one of those things happen, I think we are severely oversold. So I do think there is a bounce incoming, but it's really going to depend on earnings and the Fed, because at the bottom, at the end of the day, what matters in the stock market and when you're buying companies is fundamentals, right? How much is a company growing margins, growing revenue, growing profits, and what's the Fed doing? Is the Fed pushing us into a recession? Because that ultimately plays a role to the bottom line fundamentals of companies. So what you need to see really happen before you could go all in on margin again, before you could start buying everything you see, is the data starting to look down? Is, the growth rate, the GDP growth rate, starting to go into deep negative territory, more companies starting to go bankrupt and firing people. That could actually be intuitively a positive thing for the stock market. Normally bankruptcies would not be positive, but this time around that might actually be seen as a positive thing for the stock market given the Fed's agenda that they have in 2022. Also, what we need to see are stocks like Apple, some of the safe haven trades, your energy companies, right? Some of your healthcare companies start to take a big hit like the technology stocks, and that has started to happen. Take a look at Apple today, down 2%, whereas AMC is only down 0.39%, right? You need to see the safe havens get destroyed and to really shake up that capital that has been hiding in those safe haven areas. Also, a big factor that is contributing to the stock market going down in value throughout 2022 has been this epic rise in the US dollar, and you want to see the dollar start to fall in a big way. This chart correlates ever since it's been going higher in 2022, really started in November of 2021. Technology stocks have been getting the runaround. They've been getting beaten down ever since then. And now you're starting to see the dollar topple over, but you won't quite see that until the Fed does U-turn, and that's going to be a monumental time to be an investor in the stock market. And right now is your time to solidify your fortunes over the next couple of years by buying the dip, baby. So that's really what to look out for. That's what's going to end this pain for the stock market, right? As far as AMC stock, a brief look at the Ortex data, you have a 0% positive order value for the day. Some very large puts that did come through, $1.22 million, couple $100,000 orders, $70,000 orders, totaling about $1.82 million, and 0% positive order value. That's definitely not that great. The short interest, the value amount in dollars is $705 million. Estimated short interest of free float is 19.27%. Free float out on loans still at about 36.25%. Days to cover 4.42 and 100% share utilization. AMC on a technical basis still above this line that I have had drawn out at about $6.88 per share, so that is a positive thing. AMC starting to get a little bit of a pop right now as well. So ladies and gentlemen, that is pretty much going to be it for this video. We covered what we need to cover in a very short amount of time. If you guys like these kind of videos, hit that like button, subscribe to the channel, source your comments, questions, concerns down below in the comment section. If you guys want to get free stocks, links down below in the description for Webull, Moomoo, and Public as well. Also, like I said, if you guys want to trade with me live in real time, link down below in the description of this video also. Thank you guys for watching, and I will see you in the next one.